A lot has changed about the inflation scare that hung over markets. India's October CPI, consumer inflation, has come in line with market expectations at 6.77%. And it's on course to dip below 6% by March. The wholesale inflation, WPI, has fallen a little more sharply in October, triggering hopes that lower wholesale prices will eventually start getting passed on to consumers and therefore bring down CPI. The US October CPI number was also lower than what the market expected, came in at 7.77 against expectations of 8% by the market. So are we in for a lowering of rate hike expectations from the RBI as well? Or will possible rupee worries, rupee weakness, worry the Reserve Bank from going too fast? We have with us two experts to decode the macros for us. I have with me Mridul, Saggar, former member of the MPC, former executive director at the RBI, and now with the NCAER. I also have with me Abhishek Upadhyay, senior economist at ICICI Securities, PT. Gentlemen, thank you very much for joining me. Mridul, that's really the first question. If you have looked at all the numbers, does it inspire confidence that the faster fall in WPI can get passed on? Are you feeling a little more comfortable about the CPI decline at all?
Not really, Lata. I mean, the way I read this CPI number was a delta zero. You know, it is neither positive nor negative. There are two or three clear positives with this number. The headline inflation has dropped by 64 basis points, as you mentioned. This is led by fall in food inflation from 8.4 to 7%. So that is one positive. The second is that inflation isn't yet becoming generalized, more generalized than it already has. In fact, the diffusion indices in these for this month of October, they seem to have come down. Looking at 297 odd items which form this CPI, if one sees the price movements therein, percentage increase in October, 75% of the items witnessed a price increase month on month as compared to 78.2% in September. The third aspect is that some momentum in core inflation seemed to have come down. I mean, in August, it was 0.63. In September, it came down to 0.44. In October, further to 0.33. So that is one good news. But overall inflation, neither the core inflation has come down. That remains pretty sticky around 6% for last 18 months. And also, there has been a significant pickup in average momentum of the headline inflation. So that's one worry I have still, like that is being caused. So I think rural inflation is also tracking 0.5 percentage point higher than the urban inflation in this financial year. So what does the monetary policy do? I think it's premature to pivot the stance. Inflation must be brought down on a more enduring basis, and one needs to keep a watch. But obviously, as growth comes down later on, sooner or later, this monetary policy stance will need to change if inflation, if growth really comes down.
Okay. I'll just come back to you for the WPI impact as well. Let me get first thoughts from Abhishek. Abhishek, has the number left you any more confident that we are getting to under 6 or at least 6 by March and therefore on course?
Not really, Lata. So that is the worry. As Mridul mentioned, the bottom-up perspective of the latest inflation data doesn't reveal anything to suggest that price pressures are really slowing down. Core inflation, of course, 6%, but we also construct this sticky price inflation index, which aggregates inflation across all the less volatile parts of headline inflation, food, fuel, or core. And we think that is a better measure of underlying inflation. And that remained flat at 7.4% YOY. So core inflation at 6%, all the variety of underlying metrics of which proxy underlying inflation also firmly above 6%. And food inflation, which has been a key worry, rose 1% month on month. That rise is still about double the pace of increase you used to see in the same month in the pre-COVID years. So food inflation also, despite the strong acceleration we saw earlier in the fiscal, after the shock to global food and energy prices, still not showing signs of abating, even as globally things are much better. So all said, we think inflation Jan-March will be higher than what RBI thinks, 5.8%. Our number is close to 6.5%.
Oh.
And that also informs our views on monetary policy.
Okay. Yes, I mean, several economists I spoke to said that the index number itself, whatever that was, 175.6 or something, has to be at 175.6 even in March for the RBI forecast to work. And, one upside shock can disturb that number. That was the view I got. But nevertheless, Mridul, only a little word on the WPI. See, the core WPI has fallen substantially, isn't it? 4.6. You don't think that sooner or later that can get passed on, and therefore this worry about sticky core may abate?
Absolutely right, Lata. I mean, the WPI will pass on later on a few months down the line and give CPI the respite. But a lot eventually would also depend on global inflation. And I think we need to wait and watch how the commodity prices correct. At that juncture, we will really have a respite on inflation coming through even in the core segment as to say lower transportation costs.
I want to parse the global environment, especially the Fed speak, a little more, since it appears that the first winds of change of pace of rate hikes is coming over there. We heard from the Fed Vice Chair today, Lael Bernard, speaking about whether we should start looking at, I'm not quoting her exactly, but that quote is running on the screen, that we have to probably start looking at lower rate hikes. But Abhishek, before that, from the little bit of dipstick survey I did with economists, about a month back, when we were struggling with the high US CPI and the hawkish Fed stance, the debate was whether there should be a 35 or a 50 in December. But today, my dipstick indicated that people are struggling between 25 and 35. Have expectations for December come down?
Well, that is because dollar has weakened and pressure on rupee, which has been a key driver of, at least the perception is that pressures on rupee has been key driver of aggressive rate hikes by RBI. That is playing a role. Our own view is that one data point in US is not a trend really. We have seen this happen in the past also, where one data point was soft and bond markets rallied, dollar weakened, but then we again got another leg higher in these variables. So it's possible that dollar, which is very rich on most valuation metrics, will ease at some point of time and will soften. But at least when you're looking at the Fed, we still think it is likely that Fed funds rate will go close to 5%. And in that environment, given the kind of CAD we have, even as peak balance of payment stress is over, because CAD will be lower than first half of the fiscal when crude prices were higher. And we are no longer seeing those FPI outflows anyways. But still, it would merit RBI to have a cautious approach and hike by at least 35 basis points. So focus can be on stepping down on pace of rate hikes, but I'm not sure the debate has shifted to doing 25 bips instead of 50 bips.
I'm very glad you took the conversation to the current account deficit, Abhishek, because I was getting there myself. We had these media reports suggesting that the October export fall has been very sharp. They spoke about double digits. I think I read a number called 19%. But because last time around the provisional numbers were lower than the final number that we got, the final export number was about $2 billion more. They're not releasing the provisional estimate. Mridul, is that a big fear that, current account deficit is still not over? If indeed it is a 19% or a 15% fall in exports, then that is something that will be on RBI's radar while setting rates?
So it will get some weight for sure. I mean, CAD, to my mind, would still track 3.4% this year of GDP. But I think let's step back and come back to the core monetary policy here. I don't think the rate hike, even if there was no pressure of rupee or the current account, I don't think there's a case for kind of reaching a terminal rate stage at this juncture, because actually you see the weighted average term deposit in real terms is minus 1.7%. If you see the latest numbers which have been put out by the RBI. So I think we are still living in that phase of negative real deposit rates. And therefore, monetary policy tightening, more of it is needed at this juncture and to complete that process. And further, this is where it will also keep saving investment gap wide because of these negative real rates. And therefore, your argument of current account being a worry is pretty much valid in that context. So I think what we are going to see here is that there would be a Fed pivot at some stage, because clearly what we are seeing is some weakening. The Case-Shiller house price index in July and August have slumped, and this is the first ever contractions I have seen since February of 2012. I mean, the wage rates also seem to be coming off a bit. The unemployment rate is higher than Nairobi, but you see the delta in terms of the farm payrolls. They have fallen to 261,000 from a 700 plus number.
Yes.
So there is weakening which is coming in the US economy, elsewhere in Europe too. And that should come off, the commodity price, it should come off at some point, and that will give relief to the RBI. And some smoothing can be done, but some more rate hikes are needed.
Are warranted. Okay, I'm being warned about the time. Abhishek, has the peak rate hike come down for you? What were you contemplating? What are you contemplating?
We were thinking at least 6.5%. That assessment has not changed, both because we haven't changed our view on inflation based on the latest data. Also on the Fed, we think rate hikes continue even though the pace of rate hikes may slow down. So unless the third variable, which is crude prices, really suddenly comes down, suddenly we will continue to stick to this view. RBI policy rate at 6.5% when Fed funds is at 5%, and core inflation and underlying inflation measures above 6%, I think is very conservative. The risk is still that we see more rate hikes next year.
Mridul, absolutely only a few seconds left. But is there at least a downward bias to this 6.5 terminal rate that many people are talking about?
I would say, personally, I would say no. You need to reach that level to get into the positive terrain of real rates. But let's see and wait and watch how MPC assesses it.
Okay, now that's adding a touch of realism to my runaway optimism after looking at the numbers. Thank you very much, Mridul, Saggar and Abhishek Upadhyay, for joining us. Key takeaways from our experts: there is not enough in the data to believe that rate hikes can be slowed much in India. There is still need for rate hikes. They would go with at least 6.5, so that there is a positive real rate. The difference between the deposit rate and the inflation rate becomes positive. It is worth your money to put it in a bank deposit. That's where we should get, according to our experts. We wrap up on Bazaar on that note. Chartbusters is lined up next.